Welcome back to our series on innovation and disruption. After a quick detour last week to celebrate the one and only Warren Buffett, we're shifting gears straight into the future. This week, we're diving headfirst into one of the most transformative investment themes of the 21st century, and that is automation and robotics. We're talking about autonomous vehicles, drones, AI-powered bots on factory floors, humanoid robots, and much more. These aren't just concepts from sci-fi anymore. They're becoming everyday reality. And they all have two big things in common. Firstly, they're powered by AI, and secondly, they're riding some very strong tailwinds. This video will just be an overview, but if you'd like to get all the insights and go into further depth, check out the link in our description for the article. But before we jump into the machines of tomorrow, let's take a look at what happened in markets this week. Let's start with Main Street, where optimism took another hit. According to the NFIB survey, small business confidence dropped for the fourth straight month in April. Investment plans are now at their lowest levels since early COVID days. The mood is cautious. Whiplash from shifting US tariffs and a shaky economic outlook have small businesses tightening belts. That's a red flag for GDP growth and demand in B2B sectors like industrials and regional banks. Investors are already responding accordingly, rotating out of small cap cyclicals and into defensive sectors. Now onto the big geopolitical mover. This week saw a breakthrough on the US-China trade front. While it's only for 90 days, tariffs are coming down sharply. We're talking US tariffs falling from 145% to 30%, and China cutting theirs from 125% to 10%. But the real story is who's behind it: Treasury Secretary Scott Bessent. Bessent is viewed as pragmatic, and markets love it. A more coherent trade policy could boost risk appetite across the board, especially for global cyclicals and exporters. Switching gears to crypto, Coinbase just scored a huge win. It's joining the S&P 500 on May 19, replacing Discover Financial. This follows Bitcoin's breakout past $100,000 and Coinbase's $2.9 billion acquisition of Deribit. The stock could see inflows from index trackers, but don't forget, its fate still rides shotgun with crypto sentiment. And things aren't looking so rosy in healthcare. United Health is now under criminal investigation for potential Medicare fraud. Shares plunged more than 25% last week, and uncertainty is spooking the entire Medicare Advantage sector. Keep an eye on Humana and CVS. They could feel the fallout too. Over in defense, the US just inked a record $142 billion arms deal with Saudi Arabia. Big names like Lockheed, Boeing, and RTX are likely poised to benefit. And speaking of Boeing, they landed their biggest order ever. Qatar Airways is buying up to 210 wide-body jets worth a staggering $96 billion, with 400 engines from GE Aerospace to match. That's a shot in the arm for Boeing's turnaround and a big tailwind for US manufacturing. Alright, now let's get into it. The rise of automation and robotics. Humans have always had a knack for building tools that make life easier. The printing press, steam engine, textile machinery, they were all game changers in their time. And today, we're entering a whole new era. The tailwinds behind automation are stacking up fast. Several technologies are converging at once, turning science fiction into real-world deployment. AI and machine learning are giving robots the brains to handle complex, adaptive tasks. The Internet of Things connects them all, while better batteries and sensors makes them more efficient, more autonomous, and more useful. Costs are falling, and that makes these tools available to more than just the tech giants. They're now within reach of small and medium-sized businesses too. But it's not just the tech pushing this trend forward. On the demand side, demographics and geopolitical trends are adding fuel to the fire. Labor shortages in developed countries are becoming a long-term problem. Companies are under pressure to cut costs and boost productivity. And after the chaos of 2021's supply chain meltdown, the push to reshore manufacturing has automation written all over it. Even consumer behavior is changing. People are warming up to robots, not just at work, but at home too. So, where are the opportunities? Let's break it down, starting with the big players in the automation space. First up, industrial automation. This is the oldest, most mature corner of the market. Think robotic assembly lines in factories, precision machines increasing output and reducing error. Big players like Honeywell and ABB have been dominating this field for decades. Both are now planning to spin off their robotics units in the next year, creating potential pure play opportunities worth watching. Within this sector, we've also got high-precision tools like SCARA robots, essential for semiconductors and pharmaceuticals. And companies like Japan's Dafuku are capitalizing on niche markets like materials handling in chip fabrication plants. Then there's the flashier stuff, humanoid robots. Tesla's in, Boston Dynamics has been at it for years, and a wave of Chinese companies are racing to catch up. But let's be honest, these robots may walk and dance, but they're still a few years away from widespread commercial availability. Still, the momentum here is real, and the long-term potential is hard to ignore. Now let's shift over to the software side, process automation. This isn't about robots on factory floors, it's about automating admin and business tasks. It's everything from logistics and healthcare workflows to back-office operations. UiPath is a name to know here, as a pioneer of end-to-end automation. Salesforce is also getting in deeper, layering in AI to automate data handling. Next, we've got service robotics. These bots work outside traditional factories, in logistics, medicine, agriculture, even in your living room. Rich Tech Robotics and iRobot are making waves here. Roomba may be a household name, but logistics and surgical robots are where we're seeing serious adoption. Symbotic and Serve Robotics are transforming warehouses, while Intuitive Surgical continues to lead in robotic-assisted surgery. Autonomous vehicles and drone tech deserve their own spotlight. Tesla and Waymo are leading the robo-taxi race in the US, with a few Chinese contenders close behind. Meanwhile, drone tech has moved faster than many expected. From military use in Ukraine to commercial inspections, agriculture, and yes, Amazon-style delivery trials, this is one of the hottest subsectors right now. So, let's talk strategy. The automation and robotics ecosystem is bigger than just the flashy robot arms and sci-fi tech. Firstly, you've got component manufacturers, the picks and shovels of this gold rush. Think sensors, actuators, and AI chips. NVIDIA is especially key here. Then you've got software and AI developers. They're building the brains behind the bots. Next, you've got system integrators who are stitching it all together into turnkey solutions. And lastly, you've got the enabling tech like 5G, cloud robotics, and cybersecurity, which are essential for connected systems. Geographically, this is one of the more globally diversified trends out there. The US leads in AI, software, and surgical robotics. Japan and Germany bring industrial muscle. China is scaling fast across drones, AI, and robot manufacturing. South Korea and Switzerland, they're quiet powerhouses too. And Canada and the UK are punching above their weight in research and niche innovations. So, how do you invest? One easy entry point is robotics-themed ETFs. Having a look at these funds includes a mix of global leaders and hidden gems, and they generally stick close to the theme. For more targeted bets, screen for niche players using Simply Wall Street's Stock Screener. You can use keyword searches like warehouse automation, surgical robotics, or logistic robots to uncover opportunities that might not show up in standard industry filters. So what's the insight here? There are many ways to diversify your bets across the automation and robotics ecosystem. There are already some exciting companies in the robotics space, and more are likely to emerge over the next decade. Humanoid robots and flying cars are cool and all, but will they deliver for investors? If you think about the demand side of things, the industry does have a lot going for it. However, there are a few things to keep in mind with these types of companies. Robotics is very capital intensive. Not only do these machines need GPUs to power their brains, but moving parts need to be developed, built, and then tested. Secondly, there's break-even delays. There's a good chance that reaching break-even will take longer and cost more than anticipated. Third, there's lower margins. These robotic stocks aren't software stocks with 80% gross margins. And lastly, raising more capital. Companies developing these technologies often need to raise new capital, and to do that, they're likely to present the most rose-tinted outlook they can. All of this needs to be considered when assessing the companies that are prone to being overhyped. This doesn't mean you should avoid the disruptors and innovators, but there are a lot of ways to hedge your bets. This industry stands to benefit from strong secular trends for a long time. As we mentioned last week, Warren Buffett generated great returns investing in companies that compounded slowly and steadily. The robotics and automation industry includes innovators, companies with decades-long track records, and of course, all the other companies in the value chain. So whether you're in it for the sci-fi thrill or the steady compounding, This is one secular trend you should definitely keep your eye on. And that's where we'll wrap up this week's Market Insights. If you're enjoying these Market Insights, please don't forget to like and subscribe and let us know if you have any feedback. We'll be back next week with some more Market Insights. Until then, invest well.